Price caps, subsidies, and similar interventions are popular, but they distort prices. They're often poorly designed, hard to unwind, and extremely costly. Most countries don't have that luxury anymore. Where support for the most vulnerable is needed, targeted and temporary measures should be deployed, consistent with medium-term plans to rebuild fiscal buffers and avoiding stimulating demand where inflation is rising. Finally, if financial conditions tighten sharply, as in our severe scenario, and global activity deteriorates markedly, monetary and fiscal policy should be ready to pivot to support the economy and safeguard the financial system alongside appropriate financial and liquidity policies. Now, the war demands immediate attention, yet it should not derail from the pursuit of durable growth. It should also spur faster adoption of renewable energy, which can strengthen resilience to energy shocks, improve energy security, and support the climate transition. Advances in artificial intelligence promise large productivity gains, lifting living standards. But the transition may be bumpy. Markets may well be ahead of fundamentals. New jobs will emerge, but some existing ones will also disappear. Policymakers should promote adoption while easing the labor market transition. The world economy faces another difficult test: fraying alliances, new conflicts, and waves of inward-looking policies such as trade restrictions undermine cooperation and growth. Growing strains on international order are pushing toward a multipolar world. But a more multipolar world need not be a more fragmented one. In fact, countries are finding new trade partners and forming trade agreements beyond traditional geopolitical lines. We should keep strengthening global cooperation. With the right policies, including a swift cessation of hostilities and reopening of the Strait of Hormuz, the damage can remain limited. Thank you.
Thank you, Pierre-Olivier. And now we are going to turn to your questions, but let me remind some ground rules. If you have a question, please raise your hand and wait until I call on you. If I do, identify yourself and the media outlet that you represent. This time around, just to try to take as many questions as possible, I'm going to be rounding questions and grouping them. So stay tuned for that. Also, we are here to discuss the world economic outlook. Questions regarding programs, negotiations, or institutional matters are not for this forum, but basically you will have a chance to ask about those topics later in the week. So I'm going to start compiling some questions, global questions. So if you have global questions, I'm going to start with the lady on the second row there.
Stand up and identify yourself.
Hi, good morning. Jorgelina Rosario with Bloomberg. I just wanted to ask, as there doesn't seem to be a resolution on the conflict in the Middle East, do you think that the adverse scenario is more probable now? And in that case, you still think that central banks should wait and see? I'm talking about the 2.5 growth scenario. And also, with all these shocks that the IMF highlights that are more permanent and they're coming more frequently, do you expect to, or are you thinking of updating the WEO more often throughout the year? Thank you so much.
Thank you, Pierre-Olivier. We're going to take another question. I'm going to go to the front here. Don't worry, we will go to more rounds, so stay patient.
Good morning, Noor Ammasha from Asharq Bloomberg. Pierre, how concerned are you about the strong dollar at this point dampening the efforts of growth and inflation containment, especially that this strength of the dollar is increasing with all the inflation expectations? Thank you.
Okay, another global question that will be the last. I'm going to go with the gentleman here.
Barry Wood, the American Dispatch column, the Daily Friend. Pierre, you're an economic historian. How do you compare this oil shock with the two in the 1970s?
Perfect. Pierre-Olivier.
So let me address these questions. So first on the scenario. So precisely because we are in a very fluid environment, and you can see the news every day, things are changing in a material way. we felt that we had to, instead of having a baseline, have something, our reference forecast, and then supplement that with other scenarios that would look at more extreme developments in energy markets. The reference forecast has as its core an assumption of a relatively limited conflict that gets resolved in the second half of the year, and then with energy prices that are normalizing in that second half of the year and then into next year. Very clearly, with every day that passes where we don't have a resolution, where the flow of oil and gas is more limited through the Strait of Hormuz, we're moving away from that scenario. But does it mean that that scenario is not relevant? Well, not quite yet. That scenario's core assumption is that oil prices would be around $80 this year. That's an average for the year. Of course, we're above that now. We're close to 100. But we could still have a normalization if a solution is found that would bring down energy prices towards that scenario's assumption. So I would say that we are somewhere in between the reference scenario and the adverse scenario. And of course, every day that passes and every day that we have more disruption in energy, we are drifting closer towards the adverse scenario. We're planning to update more frequently, where we are doing two full World Economic Outlook reports every year, the one that we're presenting today, then one during our annual meetings in October. But we'll also have two updates, one in July and one in January. And so our next rendezvous point will be when we have our WEO update in July. On the dollar and the impact that this may have, this is one of the channels through which financial tightening can affect emerging and developing economies. Typically, when we have uncertainty in the global economy, when there is a risk-off episode, investors look for safety. They move their assets towards safer assets. Often that means U.S. Treasuries or similar type of assets, and that is associated with the dollar appreciation. This is what we've seen in the wake of the war in the Middle East. It's been a modest appreciation by historical standards, but nonetheless, it's an appreciation. And that appreciation is creating inflation pressures in other countries. They see a depreciation of their currency from their end. And it also is tightening financial conditions because many of these countries have dollar liabilities. So that's certainly making things more difficult for them. And that's one of the channels that we explore also in our adverse and our severe scenario. Now, how does it compare to previous oil price shocks? I made a reference in my opening remarks to 2022. That's the most recent energy surge that we had on record. But of course, the reference to the 70s is also important. So let me make 2 points on this. First, our estimates right now is that if the conflict were to stop today, the oil shortfall for the year, including the fact that facilities have been damaged and it will take time for them to come back online, even if everything were to stop today, is comparable to the shock from the 1970s in terms of how much oil has been withdrawn from the market on an annual average basis. So the shock is comparable to the 1974 oil price shock. There are, however, two important differences compared to that shock. The first one is that the global economy is much less oil dependent now than it was back then. There are many other sources of energy, renewables, nuclear, and other things. And also, the global economy has become much more efficient in terms of how much it needs oil to produce GDP. And so that's a source of resilience, if you want. The second source of resilience has to do with policies. Back in the 70s, central banks looked first and foremost to try to support activity and not try to rein in inflation. And that led to macroeconomic instability, what was initially a relative price shock, the price of oil increasing relative to other prices, morphed into an inflation problem, all the prices and wages going up. Central banks have learned. They've built frameworks, they've become more independent, they've adopted frameworks that allow them to focus on price stability, and everyone knows that, and therefore they have, whether households or the private sector, inflation expectations remain fairly low because they believe central banks will deliver on their mandate. That's a critical difference with what we had also in the 70s, and that's something that is going to be important going forward.
Thank you, Pierre-Olivier. We're going to go to another round of global questions, two quick questions, and then we will move into more regional ones. So I'm going to go the gentleman here in the second row.
Красенков Кирилл, РИА Новости. Another question about the 1970s. Are there any lessons from that period that we could use to avoid any possible stagflation, especially if the conflict in the Middle East continues further? Thank you.
And I'm going to move to the lady in the first row.
Anica Taliskovic, Serbian National Television. If this looks like, is this a new 70s, does it mean that that shock will lead us into inflation, and does it mean that will lead us into interest rate growth?
Do you want me to answer?
Yes, please.
Okay. Thank you. So these two questions are very related to the previous one that was asked. So the lesson from that period is you don't want to let an energy shock turn into an ongoing inflation problem. So this is why in my remarks I said, of course, central banks cannot do anything about the price of oil, but they can do something about preventing the emergence of wage price spirals, a de-anchoring of inflation expectations, and they're expected to do that. So they don't have to step on the brakes right away. They can afford for the major central banks, whether we're looking at the Federal Reserve, the European Central Bank, Bank of Japan, or the Bank of England, we don't necessarily think that they need to raise interest rates right away. But if they see signs that inflation is taking hold, that if they see signs that there are wage price spirals, if they see signs that households and businesses start expecting a more permanent and persistent inflation, then they will need to take action. And that's one of the big lessons that has been learned in the 70s and that we should not forget. The other lesson from that period is the importance, as I mentioned in my opening remarks, the importance of energy diversification. It's very clear that the best way, and that was something that a number of countries did already in the 70s, and many more countries will do now, is to find ways in which they can diversify their sources of energy, rely more on sources of energy that they can produce domestically. Often that means renewables, and so we're likely to see a big push in that direction. So inflation is going to be there. If you look at our forecast, we're projecting 4.4% inflation this year. That's headline inflation. And we're projecting a slight increase in core inflation. But under our reference forecast, this is expected to fade away into next year. And in 2027, we would be back on the disinflation path that we've been on for the last few years. Of course, if the shock gets larger, if the disruptions get more severe, then we could get more of an inflation shock that would last more into next year. And under our severe scenario, for instance, inflation would rise to 5.8% this year and 6% next year. So those would be much higher levels of inflation.
Okay, I'm going to turn to WebEx first. I just want to remind everyone that we have reporters joining us on WebEx and through the press center. So I see Ikai, please, where coming?
Yes, Koeva, Itai Media Group. A question on China. So growth in China for 2026 is revised upward by 0.2 percentage point relative to October to 4.4% this year. And it's a modest markdown compared to the January projection. So how do you assess the impact of this conflict on the Chinese economy and its resilience in weathering external shocks? Thank you.
And before we answer this question, as we are in China, Asia, any other question in the room on the region? Please, the lady in the first row.
Thank you. Karishma here from Business Today, India Today Group. You've mentioned that how fiscal space has shrunk and that's of course resulted in rising public debt. From emerging markets scenario for the Asia Pacific, say markets like India and rest, where do you see the policymakers to prepare such vulnerabilities?
And I think you can answer.
Okay. So on China, yes, we have a slight downward revision compared to our January forecast for China to 4.4%. We were projecting in January 4.5%. And it is an upward revision from October. There's been, the Chinese economy has been doing quite well in the last part of last year, and so some of this is a carryover, if you want, from the strong performance in 2025. But then, of course, there is some impact of the war in the Middle East. Tariffs that in January, following the decision by the US Supreme Court to rule out IEEPA tariffs, that lowers the effective tariff rate that the Chinese economy is facing, even if some of it has been replaced imposed by Section 122. And so overall, that also helps the Chinese economy. And finally, there is some additional fiscal support that has been provided. So all of this together leads to a modest correction for the Chinese growth number in 2026 relative to what we had in January under the reference forecast. Now, the Chinese economy remains an economy that is expected to see its growth rate come down. So it was 5% in 25. Now it's 4.4, and it's expected to be 4% in 27. And that reflects some of the domestic imbalances in that economy between an export sector that is doing quite well. There have been very strong performance on the export side, but a domestic side of the economy, domestic consumption, that's still fairly weak. And going forward, that's becoming more and more of a headwind for the Chinese economy to try to grow essentially through the external sector, and there is a need to rebalance the growth drivers from the external sector to the domestic sector. That's something that we've emphasized in our consultations with the authorities. On the question that was asked about debt for emerging market economies, now the starting point here, and we had the whole chapter of our report in October, is one where emerging market economies have been weathering the recent shocks fairly well, maybe better than anyone would have anticipated. They've demonstrated a huge amount of resilience to the inflation surge, to the COVID period. So the last 10, 15, 20 years have been a period where emerging market economies have really improved their macroeconomic policymaking, their frameworks, and that resilience is likely to be tested. A number of them have elevated debt levels. They don't have a lot of room on the fiscal side, and therefore whatever measures they would need to deploy in order to protect the most vulnerable part of their population as a result of energy and food price increases will have to be very, very narrowly targeted and very much within their budgetary envelope.
Okay, we go back to the room. I'm going to go second row here.
Hi, good morning. Sue Chan from The Telegraph. A question about the UK. Why is the UK downgrade bigger than other major economies? What can we do about it? And you say in the forecast that you expect the impact of rising energy prices to linger in the UK. Why is that?
Okay, any other questions on the UK? Don't worry, we will get to more rounds. I'm just trying to be as effective as possible.
Yeah, Alex Brummer from the Daily Mail. The UK has a history of wage price inflation, and indeed there are industrial disputes going on at the moment in the National Health Service. I just wondered if you fear that the UK could be back into a wage price cycle of the 1970s.
And before you answer, Pierre-Olivier, we have another question from Tim Wallace from The Telegraph, also saying, please, can you expand on the reasons for the UK downgrade?
Yes, very happy to do that. So on the UK downgrade, we have, the UK's numbers are revised down for 2026 by 0.5 percentage point. So we're projecting a growth rate of 0.8%. Now, there are two main reasons for this. The first one is the war in the Middle East, of course, and I'll expand on that in a minute. But there is also the fact that there was a relatively weak performance of the UK economy in the second half of last year, and the way the numbers are computed, there is what we call a carryover. So there is a kind of a shadow effect of that growth into 2026, and that also contributes to a lower growth number overall. But there is an expectation of a rebound in 2027, and growth is expected to be at 1.3%. Now, the impact of the war in the Middle East for the UK is, of course, coming through energy price, and in particular gas prices. And the UK is highly reliant on gas for its energy mix. Now, a lot of this gas is produced domestically, but there is still a part of it that is imported, and the part that is imported is at market prices. It's much more expensive, and that kind of sets the price for energy in the UK in an environment in which gas reserves are relatively low when you compare them to other European countries. So there is more of a pass-through, if you want, of gas prices into wholesale prices of energy, even if households are protected temporarily because there are some measures in place. So there is an impact of the developments in the Middle East and the disruptions in energy markets in the UK. Now, even we are revising up inflation for the UK as well. Headline inflation, we're expecting 3.2% next year. But we're not moving very much our estimate for core inflation. It's expected to be above 2%, but only marginally up from what we were projecting in January, around 2.7%. And the reason for that, and that's how I'm getting to the question about the wage price spiral, is the UK economy still has a negative output gap in our estimate. So there is quite a bit of slack, and that actually is moderating some of the wage pressures. Now, we'll have to see and watch how the increase in energy prices, especially when they get to consumers, whether that translates into a different dynamic. But right now, there is little evidence that there are strong wage pressures in the UK economy, and therefore, under the reference forecast, our estimates of core inflation are not increasing too much.
Okay, we have a question regarding Europe that comes from Gianluca di Don Francesco Il Sole 24 Ore. Will it be right thing to do for the EU to put on hold its stability pact? That's one. Any other questions regarding European countries in the room? I'm going to go to the gentleman there.
Yes, Hugo Dixon, Reuters. I have a question. Have you done an analysis of if there are tolls on the Strait of Hormuz, whether that will be primarily absorbed by the consumers in Europe and elsewhere, or by the producers?
I think we can go ahead.
Right, on the question of the EU Stability and Growth Pact, I mean, our assessment is that a number of European economies really need to bring rebuild their fiscal buffers, bring their deficits, especially their structural deficits, down. And they are on their way doing that under the EU rules. It's a multi-year plan, so they have objectives in 2029, 2030, 2031. They don't do it in one go, but they are on their path to get there. And it's very important to stay the course. It's very important to continue rebuilding those fiscal buffers, not deviate, not suspend the rules, because there is the energy price shock. And if measures need to be taken, again, to support maybe the most dependent or the most vulnerable categories of households or some businesses, maybe, that are more dependent on energy, then those measures can be implemented, but they can be very, very targeted. They can be very temporary as well. What we've seen in the 2022 episode is a number of measures have been adopted, often very costly, 2 to 3% of GDP in many of the countries that adopted support measures that were financed by deficits, financed by debt, and often not removed as soon as the crisis is abated. People like it when they get a subsidy or a cut in energy prices. It's politically difficult to remove them. So they need to be very clear rules on how they are removed. On tariffs and tolls on the transit shipments through the Strait of Hormuz, we haven't done detailed analysis on this. I would just venture that in an environment in which there is a very inelastic energy supply, I would think the incidence is on the consumers, not on the producers.
Okay, we go back to the room. I'm gonna see the lady on the first row.
Thank you for taking my question. My name is Nume Ekege from This Day newspaper, Nigeria. Given the tighter global financial conditions, what strategies does IMF recommend for African countries, especially Nigeria, to maintain investor confidence? And also, there's been a downgrade on Nigeria's outlook from 4.4 to 4.1. Can you tell us what's responsible for that downgrade? Thank you.
Okay, any additional questions on Sub-Saharan Africa countries? I see the gentleman next. Yeah.
Okay. So my name is Desmond Okon. I write for the Cable News Nigeria. So Nigeria is targeting a single-digit inflation of between 6 to 9%. Given the current global shocks, how realistic is that? That's one. All three warring countries are close to the fund. Apart from all you do and your core functions, is there any internal engagement on the part of the fund to see what they can do to potentially end the war? Thank you very much.
So on sub-Saharan Africa, I mean, we are seeing, just very broadly, and then I'll turn it over to Deniz, we are seeing some downgrade of growth, and we are seeing some uptick in inflation in a number of countries in the region. So the impact is very much along the lines of what we see more broadly, which is for a lot of the countries, especially the ones that are energy importers, but there are also energy exporters in the region, and so there is some differentiation in terms of the impact. On the fund engagement more broadly, I mean, we are certainly following with a number of countries what their needs might be in the current environment. We're certainly coordinating as well. Our managing director has started a coordination group with the IEA and the World Bank, so we're following developments in energy markets very, very closely. And of course, we're calling for a very swift end to the hostilities and a normalization in energy markets. But Deniz, over to you.
Thank you, Pierre-Olivier, and thank you for the question on sub-Saharan Africa, and in particular in Nigeria as well. So for sub-Saharan Africa, we need to, taking a step back, actually 2025 was a relatively strong year, and before the war began, global growth prospects being resilient, and non-oil commodity prices being strong, and external financial conditions being supportive actually helped a lot of countries in the region. Now, with the war, we have reduced global growth and softened prices for non-oil commodities, and also worsened in terms of trade for oil importers, and that's an important aspect for variation within the region as well. And on top of that, the region is also facing significant challenges from headwinds from declining foreign aid, which on the bilateral aid cuts range from 16% to 28% in 2025, and we project that trend to continue. Now, how is that affecting the economy? As Pierre-Olivier said, we have a downgrade on growth by 0.4 percentage point cumulatively for 26 and 27, and at the same time, median inflation in sub-Saharan Africa is projected to go up from 3.4% in 2025 to 5% in 2026. And that's all reflecting the high oil and fertilizer prices, fuel shortages potentially, and rising borrowing costs. And fertilizer prices in particular are a concern for the region because of its dependence on agricultural products as well, and existing level of food insecurity. Now, turning to Nigeria quickly, we have revised down Nigerian growth as well by 0.3 percentage point to 4.1 in 2026, and that is reflecting a balance of two forces. One is that the war-related higher fuel and fertilizer prices and higher shipping costs that I mentioned are going to weigh on non-oil activity in Nigeria. There's some offset coming from higher oil prices, but at the end of the day, the balance is for weighing on growth in 26, with some recovery built in 2027. As far as inflation developments go, we believe that tight monetary policy and remaining data dependent and watching very carefully both exchange rate movements and inflation expectations is going to be crucial to achieve the inflation target of the central bank.
Okay, we have 10 minutes and 2 regions to cover. We're going to go to the Middle East. I'm going to go first to WebEx. I see Doha in the WebEx. So Doha, please come in.
Hello, Jose. Thank you so much for taking my question. Good morning, Pierre, Petya, and Deniz. Happy Easter all, and good morning for all